So now, let's analyze the long call position. When we expect an increase in the stock price, profits can be maximized by purchasing a call option. According to technical analysis, we will get a bullish signal when the stock meets the following criteria: stock price at support level or lower channel line, increase in volume, and RSI near or below 30%. When we are investing in options, whether they are calls or puts, we must perform technical analysis to the underlying stock. That is, we must always perform technical analysis to the underlying asset. Let's consider the following example. On August 19, 2011, the eBay company gave us a clear bullish signal because the stock touched support, and this was accompanied by an increase in volume and an RSI below 30%. As we said, on Friday, August 19, 2011, eBay gave us a clear bullish signal. Suppose at that time we had decided to buy call options in order to maximize the profits of this increase in the stock price. At the close of that day, eBay was trading at about $27, so we had bought 10 call option contracts with a strike price of $28 and expiration in September 2011. That is, we had bought 10 eBay September 2011 strike price $28 calls. The August options expired on that Friday, so it did not make sense to buy them. The premium of each contract was $1.3, so a single contract had a cost of $130. Remember that an option contract represents 100 shares. Thus, the 10 contracts would have cost us $1,300. With the 10 contracts, we would be in control of 1,000 shares. It is important to note that the calls are out of the money. This is because the strike price of the calls is higher than the stock price. A few days later, the stock started to rise until it reached the price of $31 on August 30, touching the 15-day resistance. That can be seen here. We buy the calls on August 19, the day we got the bullish signal, and a few days later, on August 30, the stock reached the price of $31, touching the 15-day resistance. At that time, the premium of the contracts was $3.4, so the 10 contracts would be worth $3,400. If we had sold them at that time, we would have made a profit of $2.1 per share. Thus, we would have had a total profit of $2,100, making a 162% return on investment. That is, a gain of 1.62 times the money invested in only 11 days. On the other hand, if we had bought 1,000 shares of eBay at the initial price of $27, instead of having bought the 10 calls, we would have invested $27,000. With options, we only invested $1,300. If we had sold the shares at $31, we would have made a profit of $4 per share. We bought at $27 and we sold at $31. That is, we would have made a total profit of $4,000, making a 15% return on investment. With options, in contrast, we had a return of 162%. That's why options, here we can see by comparison, allow us to leverage positions, that is, to make higher returns than those produced from investing in stocks. After August 30, the stock price fell for a few days, but then rose to a high of nearly $34 on Friday, September 16, the day of options expiration. At that time, the stock almost touched the 3-month resistance. That can be seen here. After August 30, the stock price dropped a little, but then rose again, and finally, on the expiration day of the options, which was September 16, the stock almost touched the 3-month resistance. At that time, the premium of the contracts was $5.7, so the 10 contracts would be worth $5,700. If we had sold them at that time, we would have made a profit of $4.4 per share. Thus, we would have had a total profit of $4,400, making a 338% return on investment. That is, a gain of 3.38 times the money invested in only 28 days. On the other hand, if we had bought 1,000 shares of eBay at the initial price of $27, instead of having bought the 10 calls, we would have invested $27,000. With options, we only invested $1,300. If we had sold the shares at $34, we would have made a profit of $7 per share. We bought at $27 and we sold at $34. That is, we would have made a total profit of $7,000, making a 26% return on investment. With options, in contrast, we had a return of 338%. Clearly, here we can see the leverage effect of investing in options. Well, now let's analyze the risk graph for the long call position. What we can see here is a graph with two axes. On the vertical axis, they are indicated the profits or losses of the position, and on the horizontal axis, it is indicated the stock price. It is important to mention that the graph indicates the profits and losses of the position at expiration, and besides, the values do not include brokerage commissions. So, what are plotted on the graph are the profits and losses of the position in relation to the stock price at option expiration. In this case, of course, it is a call. The maximum profit we can make when buying a call option is unlimited. This is because the stock price can grow indefinitely. And if the stock price increases indefinitely, the premium of the call option will increase too. On the other hand, the maximum loss that we are exposed to when buying a call option is limited, because the most we can lose is the entire premium paid for the option. That occurs when the stock price at option expiration is lower than the strike price of the option. That is, the maximum loss occurs when the option expires out of the money. At option expiration, in the case of being in a profitable position, the profit is calculated as the stock price minus the strike price of the option minus the premium paid. A very important value of the graph is the one known as break-even point. For the long call position, the break-even point is calculated as the strike price of the option plus the premium paid. The break-even point is very important because it represents the stock price at which we move from a losing to a profitable situation, or vice versa. In our case, for stock prices lower than the break-even point, we are in a losing situation. In the case that the stock price is lower than the strike price of the option, the loss of the position is maximum and is equal to the entire premium paid. In contrast, for stock prices higher than the break-even point, we are in a profitable situation. The profit is calculated as the stock price minus the strike price of the option minus the premium paid.